Breaking news out of Iraq today is sending ripples through global financial markets. The Central Bank of Iraq has issued a sweeping new policy announcement with potential implications for millions of dinar holders, both domestically and abroad. For those who closely follow the Iraqi dinar, every directive from the central bank carries weight, and today's news is particularly significant. In this report, we'll break down the major policy changes, examine their economic implications, and explain what they could mean for currency investors. These are not minor adjustments. They represent a strategic effort by Iraq's financial leadership to stabilize the dinar and modernize its banking framework. Stay with us as we unpack the new auction regulations, reserve mandates, and international banking initiatives that could reshape Iraq's financial outlook in the months ahead. The central bank's announcement introduces a 6-month currency stabilization program built around 3 core components designed to reinforce the dinar and strengthen Iraq's economic foundation. The first component targets the long-standing foreign exchange auction system. These daily auctions have allowed banks to purchase US dollars to manage currency flow, but not without controversy. Inefficiencies and corruption have hindered fair access to foreign exchange. Under the new measures, only banks that meet stricter operational and compliance standards will qualify for participation. Analysts suggest this may reduce dollar supply in the market, gradually strengthening the dinar while curbing market manipulation. However, questions remain about how businesses dependent on dollar liquidity will adapt to these restrictions. The second pillar of the stabilization plan focuses on raising reserve requirements for banks operating within Iraq. The central bank now mandates higher dinar reserves, effectively tightening the money supply and reducing excess liquidity in circulation. This move is intended to contain inflation and stabilize consumer prices by aligning money availability with actual economic demand. Similar mechanisms are used by central banks worldwide, including the U.S. Federal Reserve, to balance growth and stability. For everyday Iraqis, the changes could translate into more predictable prices, while for businesses, they may require operational adjustments to meet new reserve thresholds. Though potentially restrictive in the short term, this measure is widely seen as a step toward long-term economic discipline. A key feature of the announcement centers on Iraq's intention to enhance its international payment infrastructure. The central bank confirmed partnerships with financial institutions in Europe and Asia aimed at upgrading cross-border payment systems. For a nation deeply reliant on trade and oil exports, improving transactional speed and transparency is vital. These advancements are expected to attract foreign investment and streamline the flow of capital. For dinar holders, enhanced international banking connections could foster greater confidence in Iraq's currency management and, over time, possibly pave the way for broader global recognition of the dinar, though such progress typically unfolds gradually. These changes carry broader significance for Iraq's economic resilience. The country's heavy dependence on oil revenues has historically exposed it to volatility when global prices shift. The new central bank framework appears to directly address that vulnerability by tightening control over dollar circulation, enforcing higher reserves, and expanding banking modernization efforts. The message is clear. Iraq aims to strengthen the dinar through structural reform rather than short-term measures. For investors and citizens alike, this represents a commitment to currency protection and financial stability, though meaningful results will take time to materialize. Perhaps the most closely watched element of the central bank's statement was its reference to a review of Iraq's exchange rate policy. While no concrete figures or dates were disclosed, the wording suggests a desire for the dinar's value to more accurately mirror the nation's economic fundamentals. This language has sparked speculation about a potential revaluation, reigniting debate among investors and analysts. Economists emphasize that such a move, while possible, is unlikely to happen abruptly. Instead, they view this as part of a gradual recalibration strategy aimed at improving fiscal transparency and reducing market vulnerability rather than an imminent surge in value. Expert reaction to the announcement has been mixed. Some economists praise the auction reforms as a decisive move against corruption and artificial price manipulation. Previously, certain banks exploited auction privileges to profit from currency spreads. Stricter participation rules could close those loopholes and foster fairer competition. However, critics warn that over-restricting dollar access may create temporary difficulties for import-dependent businesses, potentially leading to higher costs for consumers. The balance between monetary control and market flexibility will be critical in determining the success of these reforms in the coming months. For dinar investors, the central takeaway is clear. Iraq's monetary leadership is demonstrating a commitment to reinforcing the currency and restoring market confidence. However, this does not imply a rapid appreciation in value. Any potential growth is expected to occur gradually as reforms take hold. Currency markets are inherently volatile, and numerous external factors, ranging from oil prices to political stability, will continue to influence outcomes. While today's developments are encouraging, analysts advise maintaining realistic expectations and avoiding speculative narratives about overnight wealth. Line discussions have already surfaced, linking Iraq's policy overhaul to broader theories of a global currency reset. It's important to clarify that there is no verified evidence supporting these claims. Central banks routinely revise monetary strategies to stabilize domestic economies, and Iraq's measures are consistent with such national objectives. Similarly, while the exchange rate review is significant, no official figures or timelines have been released. Observers are urged to rely on verified information from the central bank rather than online speculation, which often fuels unrealistic expectations and misinformation. In the months ahead, close monitoring of Iraq's financial indicators will be essential. The central bank has pledged to publish monthly progress reports detailing the program's impact. Key metrics to watch include inflation trends, foreign exchange reserves, and bank compliance rates. A decline in inflation and an increase in reserves would suggest the reforms are gaining traction. Informed analysis based on these updates will provide a clearer picture of whether Iraq's stabilization measures are achieving their objectives. Political conditions will also be a decisive factor in the program's success. Implementation of monetary reform requires policy continuity and governmental support. Any instability or shifts in political leadership could slow the process or alter its direction. Conversely, a stable political environment would enable smoother execution of reforms and enhance investor confidence. Both domestic and international observers are watching closely, as Iraq's progress could serve as a regional benchmark for economic modernization. The international dimension of Iraq's financial reform is equally important. Strengthened partnerships with major banks in Europe and Asia are expected to facilitate faster and more reliable global transactions. Such improvements not only support trade, but also signal Iraq's seriousness about financial modernization. Over time, these collaborations could bolster investor confidence, paving the way for increased foreign participation in Iraq's banking sector. While immediate currency impacts are unlikely, the long-term benefits could be substantial in reinforcing financial stability and transparency. Oil production remains at the heart of Iraq's economic performance. As government revenues rely heavily on oil exports, fluctuations in production volumes and global prices directly influence the central bank's maneuvering capacity. And when oil revenues rise, monetary authorities gain more flexibility to maintain stability. When they fall, tighter controls may follow. For observers and investors alike, tracking oil trends alongside monetary policy will be essential to understanding Iraq's broader economic trajectory and its implications for the dinar. For Iraqi citizens, the effects of these policies may be felt both immediately and over time. Stricter banking rules and higher reserves could temporarily reduce access to foreign currency for travel or commerce. However, enhanced monetary discipline may lead to greater price stability, benefiting households and small businesses. Importers may face short-term adjustments as they adapt to new participation standards in dollar auctions. Yet in the long term, a more stable dinar could lower inflation and strengthen purchasing power across the economy. From an international investment perspective, Iraq's latest measures are being interpreted as a positive signal of reform. By tightening oversight, modernizing payment systems, and reinforcing reserves, the central bank is positioning Iraq for greater economic resilience. Should these initiatives succeed, they could attract renewed foreign interest in Iraqi enterprises and contribute to gradual market normalization. While near-term appreciation in the dinar remains improbable, growing transparency and improved policy consistency are likely to enhance long-term investor confidence.